For months, the crypto world has been fixated on one company and one question. Would Strategy, the corporate giant formerly known as MicroStrategy, start dumping its enormous pile of Bitcoin and drag the whole market down with it? Well, one of the biggest banks on the planet just looked at that fear and basically said, "You are all worried about the wrong thing." In a new report, JPMorgan argued that the real long-term threat to Bitcoin is not Strategy at all. It is something far quieter and honestly, far more interesting. So let us break down exactly what they said, why it matters, and what it could mean for the future of digital assets. Here is the headline. In a research note released to clients, JPMorgan's analysts made the case that the biggest structural risk to Bitcoin is traditional financial institutions building their own private blockchains. Not selling pressure, not a single whale, the banks themselves. To understand why that is such a big claim, we need to unpack a few ideas, so stick with me, because this is the kind of thing that separates people who actually get where finance is heading from people who are just chasing headlines. Let us start with Strategy, since that is what everyone has been talking about. Strategy has spent years buying Bitcoin, and it now controls somewhere around 4% of all the Bitcoin that will ever exist. That is a massive position, which is why traders watch its every move. If it sells, that creates selling pressure. But JPMorgan's view is that this pressure is periodic and short-term. In their own words, they do not see Strategy as the main structural threat to Bitcoin. It is a bump in the road, not the road itself. So what is the real risk? To answer that, you need to understand the difference between the two kinds of blockchains, and this is the core education of today's video. On one side, you have public permissionless blockchains. Bitcoin and Ethereum are the classic examples. Anyone in the world can use them, no permission required, and no single company controls them. On the other side, you have private permissioned blockchains. These are closed networks built and controlled by a specific institution or group of institutions. You have to be approved to use them. They offer the efficiency and programmability of blockchain technology, but with identity checks, privacy controls, and a clear owner in charge. And here's the key insight. Big financial institutions overwhelmingly prefer that second type. Why? Because private permission networks give them the things they care about most: identity verification, confidentiality, clearer governance, compliance with anti-money laundering rules, and above all, regulatory certainty. They get the upside of the technology without the volatility and the Wild West reputation of public crypto. Now here is where JPMorgan's argument gets sharp, because they pointed straight at themselves as the proof. JPMorgan runs its own permissioned blockchain platform called Kinexys, which settles transfers between big institutional clients. And that platform has already processed more than $4 trillion in cumulative transaction volume. Let that sink in. A bank built its own private blockchain rail, moved trillions of dollars across it, and never once needed Bitcoin, Ethereum, or any public token to do it. That is the entire thesis in one real-world example. So what does this actually mean for Bitcoin and the broader crypto market? JPMorgan's concern is something they call structural derating. If more and more of the important financial activity, things like tokenization, payments, and settlement, migrate onto these private networks, then the public blockchains could see less transaction activity, thinner liquidity, and weaker capital flowing in. And if the ecosystem around Bitcoin weakens, that pressure could eventually reach Bitcoin itself. There is a specific battleground to watch here, and it is the tokenization of real-world assets. This is the idea of putting things like bonds, funds, and other traditional assets onto a blockchain. Right now, that market is relatively small, around $50 billion, and a meaningful chunk of it currently lives on Ethereum. But JPMorgan warns that this might just reflect early experimentation. As the big institutions get serious, they may increasingly choose to issue, custody, and settle those assets on their own private infrastructure instead of public chains. There is another piece to this that touches something we have covered before on this channel, and that is stablecoins. Banks are exploring what are called tokenized deposits, which are basically digital versions of regular bank deposits that already sit inside the existing regulatory system. If those take off, they could reduce the need for public stablecoins in institutional payments, and it is not just JPMorgan pushing this direction. The Bank for International Settlements, which is often called the central bank for central banks, has openly warned against using public blockchains for critical financial infrastructure and instead favors closed, regulated ledgers. Now, to keep this honest, because good financial education means showing you both sides, JPMorgan did not present this as a done deal. The analysts laid out several scenarios that could challenge their own view. First, a hybrid future where public and private blockchains grow side by side and both play meaningful roles. Second, stablecoins are gaining real traction under clearer regulation, which could strengthen public networks. And third, Bitcoin simply continues to trade as digital gold, a store of value, regardless of what happens with all this institutional plumbing. Any one of those could soften the risk they described. They also flagged the regulatory angle. Even if new digital asset legislation like the Clarity Act passes later this year and brings more clarity to the rules, JPMorgan warns it might not remove this particular risk. In fact, clearer rules could speed up the issuance of bank-issued tokenized deposits, which would further strengthen incumbents. So let us tie it all together. What JPMorgan is really describing is a quiet competition for the future of finance. On one side, the open public networks on which crypto was built. On the other hand, the walled gardens are being constructed by the very institutions that crypto set out to disrupt. The provocative part of their argument is that the banks might win that race not by attacking Bitcoin, but simply by building around it. Whether that fear proves right or wrong, it is one of the most important dynamics to understand in this space right now. Quick and important reminder, everything in this video is for educational purposes only. It is not financial advice, and it is not a recommendation to buy or sell anything. Always do your own research and consider speaking with a licensed financial professional before making any decisions. If this breakdown helped you think about Bitcoin in a new way, hit that like button. It really does help the channel. Subscribe to Pisano Finance for clear, no-hype breakdowns of the stories shaping digital assets and finance. And I want to hear from you in the comments. Do you think the future belongs to open public blockchains or to the private networks being built by the big banks? Let me know where you stand. Thanks for watching, and I will see you in the next one.